You spent weeks developing your trading rules. You tested them, you refined them, you wrote them down in your trading plan. You promised yourself you would follow them religiously. They're solid rules based on sound logic and proven strategy. Monday morning, you break rule number 3. You take a trade without proper confirmation because you're excited about the setup. Tuesday afternoon, you break rule number 6. You risk 3% on a trade when your maximum is 2% because you're really confident about this one. Wednesday, you break rule number 1. You trade during news events even though your strategy explicitly forbids it. By Friday, you violated 7 of your 12 rules. Your account is down 4% for the week, not because your strategy failed, but because you didn't follow it. You sit there feeling defeated, confused, and frustrated with yourself. The question haunts you. Why do you keep breaking rules you know are correct? Why can't you just do what you've already decided to do? Why does your behavior keep contradicting your knowledge? This isn't about discipline. This isn't about trying harder. This is about understanding the psychological mechanism that causes rule breaking and why the way you're currently trying to follow your rules is actually making the problem worse.
The psychology of rule breaking in trading. Here's what's actually happening when you break your trading rules and why it keeps happening despite your best intentions. Your brain operates with 2 distinct systems that psychologists call System 1 and System 2. System 1 is your rational, analytical brain. It's slow, deliberate, logical. This is the system that created your trading rules. It carefully analyzed what works, what doesn't work, what behaviors lead to success, and what behaviors lead to failure. System 2 is your fast, automatic, emotional brain. It operates on instinct, pattern recognition, and emotional responses. It doesn't analyze, it reacts. And here's the critical point. System 1 is much faster and much stronger than System 2. When you're creating your trading rules in a calm state, reviewing past trades and planning for the future, System 2 is in control. Your rational brain thoughtfully constructs rules that optimize your trading performance. These rules are genuinely correct and would work if you followed them consistently. But when you're in an active trade, when money is at risk, when emotions are elevated, when decisions need to be made quickly, System 1 takes over. Your emotional brain doesn't consult your trading rules. It doesn't pause to analyze. It reacts based on immediate feelings, urges, and impulses. This is the fundamental conflict in trading psychology. The brain that makes your rules is not the brain that executes your trades. You're trying to use System 2 rules to control System 1 behavior, and System 1 doesn't take orders from System 2 when emotions are running high. The 5 reasons your brain ignores your rules. Rule breaking isn't random. Your brain violates your trading rules for specific psychological reasons. Reason 1. Rules feel like external constraints. Even though you created your own rules, your brain often experiences them as external limitations imposed on your freedom. Humans have a psychological drive called reactance, the desire to resist constraints on our autonomy. When you're in a trade and your rule says, "Don't add to losing positions," your brain experiences this as someone telling you what you can't do. Your emotional brain rebels against this constraint, thinking, "This is my account. These are my decisions. I'll do what I want. The rule doesn't understand this specific situation." Your brain is literally fighting against your own rules because they feel like restrictions rather than guidelines you chose. Reason 2. Rules are abstract. Emotions are concrete. Your trading rules exist as abstract concepts in your rational mind. Risk only 2% per trade is an intellectual principle. But when you're excited about a setup, that excitement is a concrete feeling you're experiencing right now in your body. Your brain always prioritizes concrete, immediate experience over abstract, future-oriented concepts. The rule says 2%, but your emotional brain is flooded with conviction chemicals that say, this trade is different, this is the one, risk more. The abstract rule can't compete with the concrete emotion. Reason 3. Rules were created in a different emotional state. You wrote your rules while calm, rational, and reviewing data objectively, but you execute trades while anxious, excited, fearful, or frustrated. These are completely different emotional states, and your brain processes information entirely differently depending on emotional state. Research in psychology shows that people make dramatically different decisions in hot emotional states versus cold rational states. Your cool, rational brain creates rules that your hot, emotional brain can't access or implement when trading pressure hits. Reason 4. Immediate gratification overrides long-term logic. Your trading rules are designed to optimize long-term results. Follow these rules consistently, and you'll be profitable over months and years. But your emotional brain doesn't care about long-term results when immediate desires are present. When you want to take a trade right now, the immediate gratification of taking action overwhelms the abstract future benefit of following your rules. Your brain is wired to prioritize immediate rewards over delayed rewards, even when delayed rewards are larger. Reason 5. Rule breaking often goes unpunished immediately. The cruelest aspect of rule breaking is that it doesn't always result in immediate negative consequences. Sometimes you break a rule and the trade still works. This intermittent reinforcement trains your brain that rule breaking is acceptable, even beneficial. Your brain learns, I broke my position sizing rule and made money anyway. Maybe the rule isn't that important. This makes future rule breaking easier because your brain has evidence that violations can work out fine.
Meet Yale, the trader with perfect rules and imperfect execution. Yale had been trading for 5 years when he finally confronted his rule-breaking problem. He wasn't a beginner. He had developed comprehensive trading rules through years of experience and analysis. His rules were excellent, truly optimized for his trading style and risk tolerance. Yale's problem wasn't his rules, it was his ability to follow them. He decided to conduct an audit. For 3 months, Yale tracked every trading decision and scored himself on rule adherence. He created a simple system. After every trade, he reviewed which rules applied to that trade and whether he followed them. The results were devastating. Rule compliance rate, 43%. Yale was following his own rules less than half the time. He was violating his own carefully constructed guidelines on 57% of his decisions. His trading wasn't being governed by his strategy. It was being governed by his moment-to-moment emotional impulses. When Yale analyzed which rules he broke most frequently, a pattern emerged. Position sizing rules violated 68% of the time. Trade frequency limits violated 59% of the time. Confirmation requirements violated 54% of the time. Stop-loss placement rules violated 47% of the time. Trading hour restrictions violated 41% of the time. Yale wasn't randomly breaking rules. He was systematically breaking the rules that restricted his immediate desires, taking more risk, trading more frequently, getting into trades faster, and staying in losing trades longer. His emotional brain was selectively violating the rules that constrained what it wanted to do right now, while following rules that didn't conflict with immediate urges. Inside Yale's mind, the moment of rule breaking. Yale decided to document his internal dialogue during a typical rule-breaking episode to understand the exact psychological process. The setup and rule identification. Thursday morning, Yale identified a potential breakout setup. According to his rules, he needed 3 confirmations before entry: volume above average, price closing above the breakout level on the 1-hour chart, and RSI showing momentum. Yale's internal dialogue during analysis. This looks promising. Let me check my confirmation requirements. Volume is good, check. Price is approaching the breakout level but hasn't closed above it yet. RSI is building but not quite there. 2 out of 3 confirmations. My rule is clear. All 3 confirmations required before entry. I need to wait. Yale knew his rule. He understood why it existed. He had data showing 3 confirmation trades had a 74% win rate, while 2 confirmation trades had only a 51% win rate. The rule was rational and proven. The emotional override. Price pushed through the breakout level and hovered just above it. Yale's heart rate increased. He felt excitement building. His internal dialogue shifted. Emotional brain. This is happening right now. The breakout is forming. You need to get in before it runs away. If you wait for all 3 confirmations, you'll miss the entry. Rational brain. The rule exists for this exact situation. Wait for the close. Wait for RSI confirmation. The rule says wait. Emotional brain. Rules are guidelines, not laws. You have to be flexible. Look at the price action. It's clearly breaking out. You have 2 confirmations. That's good enough. Close enough counts. Real traders adapt to market conditions. Rational brain. You literally have data showing 2 confirmation trades underperform. This is exactly why the rule exists. Emotional brain. That's historical data. This is happening right now. You can see it. This one is obvious. If you don't take this, you'll regret it. You'll watch it run without you. Don't be rigid. Take it. The rationalization process. Yale's emotional brain began constructing justifications. Think about all those times you followed rules too rigidly and missed opportunities. This is one of those times. You're not breaking the rule. You're exercising intelligent discretion. Professional traders don't follow rules blindly. They use judgment. This is judgment. Besides, you have 2 out of 3 confirmations. That's not really breaking the rule. That's 90% compliance. The rule is basically satisfied. The 3rd confirmation is just a technicality at this point. What's the worst that happens? If it fails, you have your stop. The risk is defined. But if you don't take it and it works, you've missed a perfect setup. The risk of missing this is higher than the risk of taking it. The rule violation. Yale entered the trade before his 3 confirmation requirement was met. The moment he clicked, his internal dialogue shifted again. There, done. It's fine. You're in. This is going to work. See? Price is already moving in your favor. Your rule would have missed this. Good thing you used discretion. For the next 30 minutes, the trade moved slightly in Yale's favor, and his emotional brain used this as validation. See? This proves that sometimes breaking rules is right. You made the correct decision by taking this. Your rules are too conservative sometimes. The consequence. 45 minutes after entry, the setup failed. Price reversed sharply. Yale's stop was hit. He lost his planned risk amount of $140. But the damage wasn't just financial. The real damage was psychological. Yale had violated his rule, gotten immediate, apparent confirmation it was right, then ultimately lost anyway. His brain now had a confused association. Rule breaking sometimes feels good initially, but leads to losses eventually. This confusion made future rule following even harder. Yale's brain had learned that rule compliance doesn't feel rewarding in the moment, while rule violation feels exciting, even if it ultimately fails.
The anatomy of rule-breaking destruction. Yale analyzed his pattern and identified exactly how rule-breaking destroyed his trading performance. Destruction Pattern 1. Strategy Invalidation. Yale's trading strategy was backtested and proven to work, but only when executed exactly as designed. Every rule violation meant he wasn't actually trading his strategy anymore.
He was trading a chaotic mixture of his strategy plus his emotional impulses. The mathematics were brutal. His 3 confirmation trades had a 74% win rate with 2.8 to 1 reward risk. His 2 confirmation trades had a 51% win rate with 1.9 to 1 reward risk. By violating his confirmation rule 54% of the time, Yale was diluting his edge so severely that his overall results were barely break-even despite having a genuinely profitable strategy. Destruction pattern 2. Confidence erosion. Every time Yale broke a rule and lost, he damaged his confidence in his own decision-making. If he couldn't trust himself to follow his own rules, how could he trust his analysis? If his behavior was unpredictable, how could his results be reliable? This confidence erosion created a vicious cycle. Lower confidence led to more emotional decision-making. More emotional decisions led to more rule-breaking. More rule-breaking led to worse results. Worse results led to even lower confidence. Destruction pattern 3. Rule degradation. Each time Yale broke a rule without immediate catastrophic consequences, the rule became weaker in his mind. His brain learned, this rule is negotiable. It's a suggestion, not a requirement. After months of intermittent rule breaking, Yale's rules had no real authority over his behavior. They were written guidelines he knew about but didn't actually follow. His trading had no structure, no consistency, no systematic edge. Yale-struction pattern 4. Rationalization skill development. The more Yale broke rules, the better he became at rationalizing rule violations. His brain developed sophisticated arguments for why each violation was justified, reasonable, even smart. This meant that over time, rule-breaking became easier, not harder. Yale was training himself to be an expert at explaining away his own guidelines. His rationalization skills were increasing while his rule compliance was decreasing. Yale-struction pattern 5. Unpredictable results. Because Yale was sometimes following his strategy and sometimes not, his results became wildly inconsistent and unpredictable. He couldn't identify what was working because he wasn't executing anything consistently. This randomness made improvement impossible. Yale couldn't refine his strategy because he wasn't really trading a strategy. He was trading a chaotic mix of good decisions and emotional impulses, making it impossible to distinguish which behaviors produced which results.
Yale's transformation, building rule integrity systems. Everything changed when Yale stopped trying to follow rules through willpower and discipline and started building systems that made rule compliance automatic and inevitable. System 1. Rule reduction, from 12 to 5. Yale's first realization was that he had too many rules. 12 different rules across different aspects of trading was cognitively overwhelming. His brain couldn't track 12 separate requirements during the stress of active trading. Yale ruthlessly prioritized. He identified the 5 rules that had the biggest impact on his results. 1. 3 confirmations required before any entry. 2. Maximum 2% risk per trade. 3. Hard stop-loss set immediately upon entry. 4. Maximum 4 trades per day. 5. No trading during major news events. These 5 rules covered 87% of what made his strategy work. By reducing from 12 rules to 5, Yale made compliance cognitively manageable. His brain could actually remember and apply 5 rules under pressure. System 2. Pre-trade rule checklist. Yale created a physical checklist that he had to complete before every single trade, not mentally, physically writing or typing responses to these questions. Does this trade have all 3 required confirmations, yes or no? What is my exact entry price? What is my exact stop-loss price? What is my position size based on 2% risk? Is this my first, second, third, or fourth trade today? Are there any major news events in the next 2 hours? The checklist couldn't be skipped. It was a mandatory gate before any trade entry was allowed. This converted his abstract rules into concrete decision points that required explicit answers. The genius of this system was that lying on the checklist felt psychologically different than vaguely breaking a rule. Writing no to "does this have 3 confirmations" and then taking the trade anyway required Yale to explicitly acknowledge his violation, which created enough psychological friction to usually prevent it. System 3. Automation of non-discretionary rules. For rules that didn't require judgment, Yale built automation. His trading platform was configured to automatically reject any order exceeding 2% account risk, automatically place stop-loss orders at his specified level upon entry, automatically block trading during his excluded news event times, automatically prevent more than 4 trade entries per day. These automations removed the possibility of violating these rules. Yale didn't need willpower or discipline for these rules because the system enforced them regardless of his emotional state. System 4. Consequence awareness documentation. Yale created a specific section in his trading journal for rule violations. Every time he violated a rule, he was required to complete this documentation. Which rule did I violate? What was my justification in the moment? What was the actual result of this trade? If I had followed the rule, what would have happened? What is the cumulative cost of this type of violation over the past month? This documentation made the consequences of rule breaking concrete and visible. Yale could see in black and white that his confirmation violations had cost him $2,100 over the past month. This concrete data was far more powerful than abstract understanding that breaking rules is bad. System 5. Identity-based rule framing. Yale changed how he thought about his rules. Instead of viewing them as restrictions on his freedom, he reframed them as definitions of his trading identity. His new internal dialogue, "I am a trader who requires 3 confirmations. That's not a rule limiting me, that's who I am. Traders who require 3 confirmations don't take 2 confirmation trades, just like marathon runners don't run half marathons when training for a full marathon. This is identity, not restriction." This identity framing transformed rule following from an act of discipline into an expression of self-concept. Yale wasn't forcing himself to follow rules, he was behaving consistently with who he was as a trader. System 6. Environmental pre-commitment. Yale created environmental pre-commitment by sharing his rules with a trading accountability partner. Every week, Yale sent his partner his rule compliance score from the past week. This external accountability created a social dimension to rule following. Breaking a rule wasn't just disappointing himself anymore, it meant reporting the violation to someone else. This added layer of accountability significantly increased his rule compliance.
The breakthrough realization. 9 months into his transformation, Yale was analyzing a setup that had only 2 of his 3 required confirmations. He felt the familiar urge to take it anyway. His emotional brain began generating rationalizations. But then, something different happened. Yale had a profound insight. These rules aren't my enemy. They're not constraints holding me back from success. They are my success. Following these rules is literally the only thing separating profitable trading from gambling. Every time I violate them, I'm choosing to gamble rather than trade. The rules don't limit my freedom, they create my edge. This reframing was transformative. Yale stopped experiencing rules as obstacles to overcome and started experiencing them as tools that enabled success.
He stopped fighting his own guidelines and started embracing them as the structure that made profitable trading possible.
Yale's results, the transformation in numbers. The changes in Yale's trading results after implementing his rule integrity systems were dramatic. Before systems. Rule compliance rate of 43%. Trading was chaotic and inconsistent. Annual return, 6%, with high volatility and frequent drawdowns. After systems. Rule compliance rate of 91%. Trading became systematic and predictable. Annual return over 18 months, 31%, with much smaller drawdowns and consistent monthly gains. More importantly, Yale's psychological experience transformed. He stopped experiencing internal conflict during trading. He stopped feeling guilty about violations because violations became rare. Trading stopped feeling like a battle with himself and started feeling like professional execution of a proven process.
How to stop breaking your rules. Your action plan. If you recognize this pattern in your trading, here's your systematic approach. Step 1. Audit your current rule compliance. For the next 20 trades, track which rules you follow and which you violate. Calculate your actual compliance rate. Make your rule-breaking pattern concrete and measurable. You cannot fix what you haven't quantified. Step 2. Identify your most important rules. You probably have too many rules. Identify the 3 to 5 rules that have the biggest impact on your results. Focus exclusively on these core rules. Complexity is the enemy of compliance. Step 3. Create your pre-trade checklist. Build a physical checklist based on your core rules that you must complete before every trade. Make this checklist impossible to skip. Written or typed, not mental. The physical act of completing it creates the friction needed to prevent violations. Step 4. Automate what you can. For any rule that doesn't require discretionary judgment, build automation. Use platform settings, risk management software, or trading tools to enforce rules at the system level. Remove the need for willpower. Step 5. Document violation consequences. Create a rule violation log in your trading journal. Track every violation, your justification, the result, and the cumulative cost. Make the consequences of rule breaking concrete through data, not just abstract understanding. Step 6. Reframe rules as identity. Stop thinking, I should follow this rule. Start thinking, I am a trader who does X. Convert rules from external constraints into expressions of your trading identity. Step 7. Build external accountability. Share your rules and your compliance rate with someone else, a trading partner, mentor, or friend. Report your weekly compliance percentage. External accountability dramatically increases adherence. Step 8. Simplify your trading environment. Remove complexity that creates rule-breaking opportunities. Trade fewer instruments. Trade specific time windows. Reduce the number of decisions you need to make. Simplicity enables compliance. The fundamental truth about trading rules. Here's what Yale ultimately learned. Your trading rules are not optional suggestions that you should try to follow when convenient. They are the precise definition of your trading edge. When you break your rules, you're not making small exceptions or exercising intelligent discretion. You're abandoning the only thing that makes you profitable and replacing it with emotional gambling. Your rules exist because they encode behaviors that produce positive expectancy over time. Every violation is a step away from positive expectancy and toward randomness. Enough violations and you no longer have a trading strategy. You have chaos. The goal isn't perfect compliance.
You're human, not a robot. But the goal is systematic, reliable compliance that keeps you operating within your edge the vast majority of the time. You don't need better rules. You need better systems for following the rules you already have. Stop relying on willpower. Start building systems that make compliance automatic. That's how rule breaking stops. That's how consistent trading becomes possible. Your rules are not your constraints. They are your edge. Follow them.